I want to start today's deep dive with a riddle.
Oh, I love a good riddle.
Yeah, well, it's a financial riddle. But honestly, it feels a lot more like a logic puzzle that's just designed to break your brain.
Okay, lay it on me.
Right. So imagine you have an investment strategy. And we're not talking about some fly-by-night crypto scheme or a penny stock thing.
Sure.
This is a strategy that has worked for literally 100 years. It is backed by Nobel Prize-winning research. It's used by the absolute smartest mathematicians, the most powerful supercomputers on Wall Street,
Okay, so we're talking about the real heavy hitters
the
here.
heaviest. And the strategy itself is actually deceptively simple. The core premise is just you buy the stuff that is going up, and you bet against the stuff that is going down.
Which intuitively, that makes a lot of sense. I mean, it's like the basic physics of the market. Objects in motion tend to stay in motion.
Exactly.
If a company is doing well, it usually keeps doing well for a while. If it's failing, it keeps failing.
Right, it's just following the current. But here is the riddle. How is it possible for that incredibly sophisticated, time-tested, follow-the-winner strategy to lose money, and I mean really hemorrhaging cash, just bleeding out every single day during a week when the broader stock market is hitting all-time record highs?
See, that sounds like a total contradiction in terms.
Right.
Because if the market is going up and your whole thing is that you own the winners, you should be popping champagne. You should be picking out colors for your new Lamborghini.
You absolutely should be. But in the first week of October 2025, that is exactly what didn't happen.
Yeah.
While the S&P 500 and the NASDAQ were just breaking records left and right, systematic hedge funds, the algorithms running this very specific strategy,
Right.
were getting absolutely crushed. They lost nearly 2% in just 4 days.
Which, just to jump in and give some context to the listener, 2% might not sound like a lot.
Yeah, to a normal person.
Right. If you're a retail trader who's used to, I don't know, a tech stock swinging 10% in an afternoon, 2% is nothing.
Sure.
But in the world of diversified, hedged, leverage-adjusted institutional investing, losing 2% in 4 days is a catastrophe. I mean, that is a lifetime of pain packed into less than a week.
It was brutal. It got dubbed the October 2025 crowding crisis. And it really highlights a paradox that I think is one of the most fascinating and, frankly, terrifying mechanics in modern finance.
It really is.
So we are doing a deep dive today into momentum investing, but not the part where everyone gets rich. We aren't here to sell you a trading course.
No, definitely not. We're looking at the dark side of this. We are talking about momentum crashes.
And just to be crystal clear right off the bat, because I know this tripped me up when I first started reading through all the source material, when we say crash in this context, we do not mean the stock market crashing, right?
Correct. And that is probably the most important distinction we can make today.
Yeah.
Usually when people hear the word crash, they immediately think of 2008 or maybe 1929. They think the whole global economy is burning down.
Everyone losing their jobs, red arrows everywhere.
Exactly. But a momentum crash is entirely distinct. It's specific to the strategy itself. And the twist, the thing that really makes your riddle work, is that this strategy doesn't crash when the world is ending. It crashes when the world is getting better.
See, that is the part that broke my brain a little bit. The strategy literally implodes precisely when the economy starts to recover.
It's totally counterintuitive.
So our mission today is to figure out why. We're going to look at this glitch in the matrix. We are going to explore the hidden mechanics of short squeezes and beta mismatches, which I know sound like very dry technical terms, but they're actually these incredible human stories of risk.
And we're going to talk about why human behavior, and now by extension algorithmic behavior, makes these crashes almost inevitable. It really is a story about what happens when a winning strategy crashes upwards.
Crashing upwards. I love that phrase. Okay, let's unpack this. Before we get to the disaster of October 2025, or even the historical examples like the Great Depression, we really need to understand the golden child itself. What exactly is momentum investing in the rigorous academic sense? Because I think lay people, and I definitely include myself in this, just think it means chasing hype. Like, oh, everyone is buying this meme stock, so I should buy it too.
Yeah, it's definitely more rigorous than just jumping on a bandwagon, although the underlying human instinct is pretty similar.
Totally.
In the academic literature specifically, if you look at the seminal work by Jagadish and Titman back in the early 90s, momentum is strictly defined. It's often summarized by a metric they call WML.
WML. Let me guess. winner minus loser.
You got it. Winner minus loser. And it describes the actual construction of the portfolio. It is fundamentally a long-short strategy.
Okay, let's pause on long-short for a second. I really want to make sure we are rock solid on the mechanics here.
Sure, it's crucial.
Because short selling is one of those terms that everyone hears.
Yeah.
They see it in movies like The Big Short, they read it in the news, but I'd wager only about maybe 10% of people could actually explain how the plumbing of a short sale works.
That's entirely fair. It is deeply counterintuitive to how we normally buy things.
Right. Because usually the logic of commerce is very simple. I buy a thing, I own the thing, and then hopefully I sell the thing later for a higher price.
Exactly.
But in this strategy, you are selling something you don't even own yet. How does that actually happen in the real world?
Okay, let's break it down simply. In the context of a momentum strategy, the short side is absolutely vital. Imagine you're looking at a company, let's call it Old Tech Corp.
Old Tech Corp. Catchy.
Right. You look at it and you think it's a dinosaur. You think the management is terrible, the products are outdated, and the stock is going to tank.
Okay.
Now, you don't own any shares of Old Tech Corp, but you still want to profit from its failure.
Schadenfreude investing. I like it.
Essentially, yes, you're monetizing their downfall. So what you do is you go to a broker and you say, listen, lend me a share of Old Tech Corp. The broker looks in their digital vault, finds a share that belongs to someone else, and lends it to you.
Okay, so now I am holding a borrowed share.
Right. And you immediately turn around and sell that borrowed share to some other random person in the open market for whatever the current price is. Let's say it's trading at $100. You hit sell.
So the share is gone.
Yeah.
But now I have $100 cash in my pocket.
Correct. You have the cash, but you also have a debt. And this is the key part. It's a very specific kind of debt. You do not owe the broker $100.
I owe them the share.
Exactly. You owe the broker one share of Old Tech Corp. Eventually, you have to give it back.
So my whole bet is that I can go back into the market and replace that borrowed share for a cheaper price later on.
You got it. You wait. If your thesis is right, and Old Tech Corp is a dinosaur, maybe the stock crashes down to $10.
So I take my $100 that I got originally and go back into the market.
You buy that exact same share back for $10.
Nice.
You hand the share back to the broker to settle your debt. The broker is perfectly happy because they got their property back, and you get to keep the $90 difference as pure profit. That is the short leg of the trade.
Got it. I am literally profiting when it dies.
Right. And in the momentum strategy, specifically that winner minus loser metric we talked about, you are doing this on a massive industrial scale. You aren't just picking one stock that you don't like. You are scanning the entire market.
So walk me through that selection process for a big fund. How do they pick them?
Well, you take the last, say, 12 months of performance for every single stock in an index, like the S&P 500.
Okay.
You rank all of them, from the absolute best performers down to the absolute worst. Then you take the top 10%, the absolute rockets, the companies that have just gone up the most over the last year, and you buy them. Those are your winners. You're long the winners.
Okay, makes sense. And the losers?
You take the bottom 10%, the absolute dogs of the market, the companies that have lost the most value over the last 12 months, and you systematically short every single one of them.
Wow. So you are betting the winners will keep winning and the losers will keep right on losing. You are essentially double dipping on the market trend.
Correct. You are long the good and short the bad. And the really fascinating thing is it works. It works incredibly well.
In all markets.
Everywhere. It works in U.S. stocks, European stocks, emerging markets. It works in government bonds, currencies, commodities. Researchers have literally found momentum working going back to the Victorian era.
That is wild to me. Usually an investment strategy works in one specific era or under one specific regulatory regime, and then it stops working when the rules change.
Exactly, but this is so robust that Eugene Fama and Kenneth French, who are basically the fathers of the efficient market hypothesis, the guys who vehemently believe you cannot consistently beat the market, they have called momentum the premier anomaly.
Premier anomaly. That sounds like a nickname for a comic book villain. Like, behold, it's the premier anomaly.
It sort of is a villain to them because according to their efficient market theory, it simply shouldn't exist. You shouldn't be able to make excess returns just by looking at a chart of past prices. Everyone has that information.
Right. If it's public knowledge, it should be baked into the price already.
It should be arbitraged away instantly. If everyone knows it works, everyone should do it until it stops working. But it persists. Decades after the initial academic papers were published, the premium is still there.
Okay, but come on. If it works everywhere, and it's been working for a century, why isn't literally every person with a brokerage account doing it? what is the catch?
Mm-hmm.
Because my grandma always taught me that if something looks too good to be true, someone is definitely about to steal your wallet.
Your grandma was a very wise woman.
She was?
And there is absolutely a catch. The catch here is the statistical distribution of the returns. In finance, we talk a lot about skewness.
Skewness. Break that down for us.
So most normal investment strategies have a pretty standard bell curve. You have some good days, you have some bad days, but mostly you have average days clustered in the middle.
Sure, a normal distribution.
Right. Momentum, however, has what we call a strong negative skew.
Which means what, in practical terms?
It means it's like picking up nickels in front of a steamroller.
Oof. That is a very vivid image.
It's the classic Wall Street description for this kind of risk profile, because most of the time, day in, day out, month after month, the strategy just prints money.
Just picking up those nickels.
Exactly. It generates very high Sharpe ratios, which is just a fancy quantitative way of saying you get a lot of return for the amount of day-to-day volatility you endure. It feels incredibly safe, it feels perfectly steady, but every once in a while,
The steamroller speeds up.
the steamroller flattens you, the strategy suffers a catastrophic drawdown, and these drawdowns, while they are infrequent, they are incredibly persistent and brutally deep. They can wipe out years of accumulated gains in a matter of weeks.
And this brings us right back to the crash. You mentioned earlier that these momentum crashes happen when things in the broader economy are actually getting better.
Yes.
Which still seems so counterintuitive to me. If I am holding a basket of the biggest winners in the market and the overall market recovers and goes up, shouldn't my winners go up too?
You would certainly think so, but you have to remember the other half of your portfolio.
The shorts.
Right. You are systematically short the losers.
I'm betting that the trash is going to stay trash.
Exactly. Now, let's look at the history to see how this actually plays out. The Daniel and Moskowitz paper, which is basically the academic Bible on this specific topic, they point to two specific historical examples that illustrate this perfectly. July and August of 1932 and the spring of 2009.
Okay, let's look at 1932. That is the Great Depression. Like the deepest, darkest part of it, right?
The absolute rock bottom. I want you to really think about the atmosphere back then. Thousands of banks have failed completely. Unemployment is astronomically high. The stock market has decimated almost every industry. Public sentiment was at absolute zero.
Total despair.
Total despair. Now imagine you were a quant running a momentum strategy in June of 1932. What exactly does your portfolio look like?
Well, if I'm supposed to be buying the winners in the middle of 1932, are there even any winners to buy?
Not really winners in the sense of rapid growth or innovation. Your winner portfolio is basically just full of the stuff that fell the least.
Ah, okay. The survivors.
Exactly. Safe, highly defensive stocks. Tobacco companies, utilities, maybe a few gold miners. Boring, utterly stable companies that were practically guaranteed not to go bankrupt no matter how bad the depression got.
Okay, so my long bucket is just a bunch of safety stocks. What about my short bucket?
Your loser portfolio is full of the companies that got absolutely slaughtered over the previous year. Highly leveraged companies, banks, heavy industry, railroads. These stocks look like they were going straight to zero. They were trading for literal pennies, and you were shorting them, betting they would finally just die.
Okay, the setup makes sense. And then what happened?
And then the market turned. Out of nowhere, in July and August of 1932, the market rallied. And it didn't just rally a little bit, it exploded. The broad market index rose 82% in just 2 months.
82%.
Yeah.
In 2 months. That is insane. We get excited when the S&P goes up 10% in a whole year now.
It's the kind of violent volatility you really only see at the bottom of a depression. It's a massive snapback. Now, here is the math that ends up killing you. Your winners, those safe, boring utility stocks, they went up too. They rose about 32% during that rally.
Honestly, that's not bad. A 32% gain in 2 months is fantastic.
It is great if you look at it in a vacuum. But remember the other side of the ledger. You are short the losers. You owe those beaten down shares back to your broker. You have to buy them back in the open market to close your trade. And the losers, those trash stocks, the banks and railroads you thought were dead, they rose 232%.
Oh, wow. I see the problem.
Yeah. If you are short something and it goes up 232%, you are completely wiped out. The liability side of your balance sheet just explodes astronomically. The momentum strategy lost nearly all of its value in 2 months, even though the broader market was soaring.
Because the things you bet against went up way, way faster than the things you bet on.
Precisely. The math just crushes you. And we saw the exact same statistical pattern repeat in 2009, coming out of the global financial crisis. The market went up 26%, but the loser stocks went up 163%.
So momentum crashes aren't market crashes at all. They are rebound crashes.
That is the perfect way to phrase it. They are panic rebounds. The strategy works great when the market is trending down in a bear market because the losers fall faster than the winners. But when the market violently snaps back, the losers rise infinitely faster than the winners.
Okay, I really want to drill down on that specific point. Why do they rise faster? Why does the trash stock explode like that? Why doesn't it just go up a normal proportionate amount compared to the rest of the market?
This is where we get into the real structural mechanics. Daniel and Moskowitz use an analogy in their paper that I think is just brilliant for visualizing this. They compare the equity of a deeply distressed company to a call option.
Ah, the option analogy. I remember reading this part in the prep, and I had to reread it like 3 times. It's really dense. So walk us through it as simply as possible.
Okay, think about a company that is teetering right on the verge of bankruptcy. Let's use a bank in early 2009 as an example. Its stock is trading at exactly $1. It has billions of dollars in debt.
Okay. It's barely breathing. It's on corporate life support.
Exactly. At that point, the stock price, that $1, isn't actually reflecting the fundamental value of the company's real estate or its desks or its brand name. The debt holders, the bond holders, they effectively own all of those hard assets. The equity is technically worthless.
So why is the stock still trading at $1? Why isn't it just zero?
Because of hope, that $1 represents the tiny fractional probability that some kind of miracle happens. It functions exactly like an out-of-the-money call option on the survival of the firm.
Okay, unpack out of the money for the listeners who might not trade options.
Sure. An option is out of the money when it has zero intrinsic value right at this moment. It only has potential value if the underlying price moves a huge amount in the future. Think of it like buying a lottery ticket.
Okay, a lottery ticket.
Right. A lottery ticket costs you $2. The little piece of paper itself is worth nothing, but the extremely remote chance of winning $100 million is what makes it worth $2 today.
Okay, I'm tracking. So the stock of the dying bank is basically just a lottery ticket betting that the company doesn't actually die.
Exactly like a lottery ticket. Now imagine the overall economy stays bad. The stock either stays at $1 or goes to zero. You lose your dollar. No big deal. That's what you expect. But let's say the government suddenly steps in and announces a massive bank bailout package, or the recession just unexpectedly ends. Suddenly, there is a real glimmer of light. The company might actually not go bankrupt.
The risk of immediate death just completely vanishes.
Exactly. And because that existential risk vanishes, the stock doesn't just go up a normal amount. It doesn't go from $1 to $1.10. The value of that lottery ticket skyrockets because the odds of it paying off just went way, way up. The stock might jump to $4 or $5 overnight.
Because it's suddenly repricing itself from probably dead to probably alive.
Yes. And mathematically speaking, going from $1 to $5 is a 400% return. In finance, this is what we call convexity. The upside is totally explosive compared to the downside.
So the loser stock is essentially a tightly coiled spring.
Exactly. It's coiled tight by the fear of bankruptcy. Meanwhile, look at the other side of your portfolio. Look at your winners. Let's say your winner is Walmart or a big utility company. They were already safe. They were already trading at $50. If the macro economy improves, sure, they go up. People have more money to spend. Maybe they go from $50 to $55. That's a solid 10% gain.
So you have a 10% gain on your longs and a 400% loss on your shorts.
And that dynamic right there is what we call the beta mismatch. Beta is just a statistical measure of a stock's sensitivity to the overall market. In the middle of a market crash, momentum portfolios accidentally end up being entirely long, low beta stocks, the safe stuff, and entirely short high beta stocks, the risky, highly volatile stuff.
So when the market suddenly rips upward?
You are long a garden hose and you are short a fire hose. You turn the water pressure on and you just get blasted against the wall.
Wow. That is a terrifying visual.
Well, okay.
But it makes perfect logical sense. You are positioning yourself for the world to stay dark and gloomy, and when the sun finally comes out, you just burn.
Exactly. You are perfectly positioned for the storm, so the clear skies ruin you.
And I think that brings us perfectly to the modern era. Because what happened in October 2025, which honestly feels like it was just yesterday, it wasn't just about beta. It wasn't just about these lottery ticket stocks. It was about market structure. It was about crowding.
Right. The October 2025 crowding crisis.
Let's set the scene for this one. I really want to put the listener in the shoes of a portfolio manager at one of these big systematic hedge funds. Let's invent a guy. Let's call him Jim.
Poor Jim. I already feel really bad for
You
him.
should. So it's October 1st, 2025. Jim is feeling fantastic. The S&P 500 is crossing 6,700. The NASDAQ is blowing past 23,000. It's this massive AI-driven rally. Everyone is thrilled about interest rate cuts coming down the pipe. It's a total Goldilocks scenario, right? Not too hot, not too cold.
Right, so notice the difference here. Unlike 1932 or 2009, this is not a rebound from the depths of a crippling depression. This is a rally building on top of another rally.
Right, and that is exactly what makes this specific case study so incredibly interesting. It proves that you don't actually need a generational depression to trigger a momentum crash. You just need a panic state, followed by an unexpected shock. So what exactly does Jim's quantitative portfolio look like in early October?
Well, Jim is playing the AI boom naturally. But Jim is smart. He's a professional. He's fully hedged. He runs a systematic, market-neutral book. On the long side, he obviously owns the king of the hill, NVIDIA. That is his ultimate winner. It's been going up steadily for 2 straight years.
Naturally, if you are breathing and in the market in 2025, you own NVIDIA.
Of course. But like we said, Jim is prudent. He knows the technology sector can be extremely volatile. He doesn't want to lose his shirt if the whole semiconductor industry suddenly tanks because of Taiwan or something. So his algorithm scans the market looking for the optimal loser in that exact same sector to act as a hedge.
And who does the algorithm find?
In this specific historical timeline, it locked onto AMD.
Now, why AMD? I always thought they were a pretty big successful player in the chip space.
They definitely are, generally speaking. But in the specific months leading up to October 2025, they had been severely lagging. They missed a crucial earnings target. There were all these swirling rumors about delays in their next-generation chip architecture. Relative to NVIDIA's hypergrowth, AMD was acting like a total dog. The stock was just bleeding out, drifting down month after month.
So Jim's algorithm simply says, buy NVIDIA, short AMD.
Exactly. It's what we call a classic pair trade. The internal logic is, I want to bet heavily on AI, so I own NVIDIA. But I don't want broad semiconductor market risk. If the whole sector falls, my short position on AMD will make money and perfectly offset the losses on NVIDIA.
Honestly, it sounds prudent.
Yeah.
It sounds like very responsible risk management.
It is responsible. It's textbook. Until the loser suddenly becomes the winner overnight.
And to the catalyst, October 6th, 2025.
Right. The press release hits the wire right at 8:00 a.m. before the market even opens. AMD announces a massive, unprecedented supply deal with OpenAI. We are talking 6 gigawatts of dedicated AI compute capacity.
Gives you just a totally staggering amount of chips.
It's an absolute game changer. It fundamentally rewrites the entire thesis for the company going forward. And the market reacts instantly. It doesn't matter one bit that AMD has been a statistical loser for the past year. The narrative flips in an absolute millisecond. AMD opens up 20% right at the bell, and it just keeps climbing all day. It finishes the day up 34%.
Okay, so AMD has an amazing day. Good for their shareholders. But why exactly did this wreck our guy Jim?
Because of the leverage. And because of the chain reaction it set off. When AMD popped 34%, Jim's short position completely exploded.
He's losing massive amounts of money on the short side.
He is losing a catastrophic amount of money. And remember, systematic hedge funds don't just trade with their own cash. They operate with heavy leverage. They borrow money from prime brokers to make these tiny statistical edges into large nominal returns.
Right.
When a heavily leveraged position moves 34% against you in a matter of hours, it doesn't just eat your daily profit, it starts eating your underlying collateral.
And that's when the broker calls.
The dreaded margin call. The prime broker picks up the phone and says, "Hey, Jim, your account is completely underwater. You need to wire us $50 million in cash by noon, or we are going to forcibly liquidate your entire portfolio."
But Jim doesn't just have $50 million in cash sitting under his mattress. Jim is fully invested in the market.
Exactly. So what does Jim have to do? He has to raise cash immediately. And where is all of his money tied up? It's tied up in his winning positions. It's in NVIDIA.
So just to survive, just to pay for the massive losses on the trash stock, AMD, he is forced to sell off his gold stock, NVIDIA.
Exactly. This is the mechanism we call forced deleveraging. Jim and thousands of other algorithms running the exact same logic as Jim are furiously selling their absolute best winners into a rising market just to stay alive.
So they're losing money on the short side because AMD went up, And they are simultaneously losing the opportunity on the long side because they're fighting to sell NVIDIA.
It's a brutal double whammy. And since literally everyone was in the exact same crowded trade,
NVIDIA stock faced this massive wave of selling pressure, even though there was absolutely nothing wrong with NVIDIA's actual business.
right, NVIDIA had no bad news that day. None. But its stock dipped significantly because everyone was panic selling it to pay for their AMD margin calls. And meanwhile, on the other side, AMD faced massive artificial buying pressure because all these funds were rushing to buy back shares to cover their shorts before they went bankrupt.
Which, of course, pushed AMD's price up even further.
The classic short squeeze. It becomes this vicious, self-fulfilling feedback loop. The source material has this incredibly profound quote: "Hedges became loss amplifiers. The very thing that was mathematically meant to protect you, the short position, became the exact thing that killed you."
It's like wearing a seatbelt, but when you hit a bump, the seatbelt tightens around your neck instead of your chest.
That is a very dark analogy, but it's remarkably accurate. And this really brings us to the core concept of crowding. Because, think about it, this wouldn't have been a systemic crisis if it was literally just our guy Jim.
Right. If I make a terrible trade in my personal account, I lose money, I cry into my coffee, and the market doesn't even blink. It just moves on. But if everyone makes the exact same bad trade at the exact same time, then we have a major problem.
Exactly. The Goldman Sachs research note from that specific week mentioned that factor crowding was at near record historical levels. It's not just that they all happen to own NVIDIA, it's that they all utilize the exact same mathematical signals to arrive at the exact same portfolio construction.
I really want to dig into this crowded room problem in a minute because the numbers are fascinating. But before we get there, I feel like we need to zoom out just a bit. We've talked a lot about the math, we've talked about the algorithms and the leverage, but ultimately, when you peel it all back, these algorithms are simply designed to exploit human behavior.
Yes, exactly. At its core, momentum is fundamentally a behavioral phenomenon.
So why does it even exist? Why do markets trend in the first place? I mean, if markets were perfectly, purely efficient, like if it was just robots trading perfectly logically with other robots, prices should adjust instantly to any new information, right? There shouldn't be long, drawn-out trends. The price of asset A should just instantly jump to price B the second news breaks.
Correct. In a perfectly efficient, perfectly rational world, if AMD announces a massive new deal, the price instantly jumps to its new fair value. And that's the end of it. There is no slow drift. There is no momentum to capture. But humans aren't perfectly rational robots. We have serious wetware problems. We have deeply ingrained cognitive biases.
The flawed human brain. So what are the specific glitches in our psychology that these momentum strategies are actually exploiting?
There are three main behavioral biases consistently cited in the academic literature. You have underreaction, you have overreaction, and you have something called the disposition effect.
Okay, let's take them one by one. Let's start with underreaction.
Underreaction is also known in psychology as conservatism bias. Basically, when completely new information comes out, say a company announces surprisingly phenomenal earnings, people are just very slow to actually change their minds.
We are stubborn creatures.
We're incredibly stubborn. We subconsciously anchor to the old price. We look at it and think, oh, it can't possibly be worth that much more just because of one good quarterly report. So investors buy a little bit, but they don't buy enough to push it to its true fair value. The price ends up drifting upwards very slowly over weeks or even months as the broader market gradually accepts the new reality. And that slow, steady drift, that is a trend. That is exactly what momentum is.
Okay, I get that. So the initial trend is just the market being incredibly slow on the uptake.
Yeah.
What about overreaction then? Where does that fit in?
That happens much later in the cycle. Eventually, the herd looks up and realizes, hey, this stock is really moving. My neighbor down the street just bought a boat because he invested in this.
FOMO kicks in.
Severe fear of missing out. It's classic herding behavior. People just start buying blindly solely because the line on the chart is going up. And this massive influx of dumb money pushes the price way past its actual fundamental value. The trend overshoots. And quantitative momentum strategies are designed to just ride that wave all the way to the top.
Fascinating. And the third one, the disposition effect.
This one is actually my favorite, honestly, because I know I am personally guilty of it all the time. The disposition effect is the documented tendency for individual investors to sell their winning stocks far too early and hold on to their losing stocks far too long.
Oh, man. The classic, I can't sell it at a loss, I'll just wait until it bounces back to break even. and then I'll sell it.
Exactly. It is psychologically painful to admit to yourself that you were wrong, so you hold on to the loser, just desperately hoping it bounces back.
Yeah.
And what this does on a macro level is it keeps the supply of the loser stock off the open market. It artificially props the price up, preventing it from crashing instantly to its true bottom. Instead, it just bleeds out slowly over time.
Creating a perfect, drawn-out downward trend for the quants to short.
Exactly. And on the flip side of that, people sell their winners way too early just to lock in a gain and feel smart, which creates this constant selling pressure that slows down the stock's upward rise. It smooths out the price movement, extending the upward trend.
So our own flawed psychology, our fear of regret, our stubbornness, our herd instinct, literally creates these slow-moving waves that the Wall Street quants surf for profit.
Yes, the algorithms are quite literally just monetizing human nature.
Yeah.
But, and there's a twist here. There is some really interesting new research specifically mentioned in the paper by Bien and Jian that connects these violent momentum crashes to something called the 52-week high effect.
The 52-week high, you're talking about the anchor price.
Right. Retail investors heavily use a stock's 52-week high as a psychological reference point. When a stock is trading incredibly far below its recent peak, when it's a massive loser, investors tend to view it as cheap.
Like, oh, look, Zoom stock is down 80% from its pandemic high. It must be a total bargain right now.
Exactly. They think it's on sale, even if the underlying company is fundamentally broken and practically bankrupt. So during a sudden market rebound, like we saw in 1932 or in October 2025, all this speculative retail money floods straight into these trash stocks, specifically because they are so far away from their 52-week highs.
The trash rally again?
The trash rally. And if your highly sophisticated momentum algorithm is just blindly shorting these stocks purely because they have bad recent momentum, you are essentially standing directly in front of a massive speculative flood. You are actively shorting the exact same lottery tickets that all the gamblers are desperately trying to buy.
So wait, is there a simple fix for this? I mean,
Yeah.
if we know academically that this anchoring bias exists, can't the quants just adjust the algorithm?
They can, and the researchers actually propose a solution. They call it a near-high neutral strategy. Basically, the rule is, don't bet against stocks solely because they are down. You have to adjust your mathematical signal to explicitly account for how far away the stock is from its historical peak. If you neutralize that specific factor, if you basically tell the algorithm, hey, do not short things just because they look incredibly cheap to retail traders, you actually eliminate a huge chunk of the crash risk.
That seems strangely simple, doesn't it? Why didn't all these brilliant PhDs think of that before they lost billions of dollars?
Well, hindsight is always 20/20. In the heat of the moment, the basic algorithm just sees, this stock is going down, therefore I should short it. It doesn't inherently know why human investors might suddenly decide to buy it out of nowhere. It doesn't understand the nuance of bargain hunting psychology unless a human explicitly programs it to look for it.
Which is a perfect segue. This leads us right to another concept that popped up a lot in the Erlang Capital commentary from the sources, this idea of endogenous risk coming from within.
Yes. This is a genuinely crucial concept for understanding how modern financial markets actually function. In the October 2025 crisis, the massive systemic risk didn't come from a war breaking out or a new pandemic or a surprising election result. The risk came entirely from the market structure itself.
They called it signal convergence.
Right. Imagine if every single GPS system in a major city told every single driver to take the exact same tiny shortcut down a side street at the exact same time.
You just instantly have the world's worst traffic jam. Nobody would move.
That is exactly what happened in the market. Systematic hedge funds all use incredibly similar inputs to build their models. They look at 200-day moving averages, they analyze volatility regimes, they track earnings surprises. They basically all bought the exact same map. So when the signal on that map flashes sell, they all try to sell at the exact same millisecond.
So the crash isn't some unpredictable black swan event. It's a built-in feature of the system.
It is a feature of a highly homogenized market. When absolutely everyone is a quant looking at the same data, true diversity of opinion completely disappears. And when diversity of opinion disappears, market liquidity disappears right along with it.
Let's talk about that liquidity piece.
Yeah.
Because you threw out a statistic earlier that really stuck with me when we were prepping. It was the difference between trading on a normal day versus trading on a crowded day.
Ah, yes. This comes from some really fascinating research by CFM, Capital Fund Management. They specifically looked at the expected value of a given trade. Basically, if you try to sell a large block of stock, How much profit do you statistically expect to actually keep after all the costs?
Okay, simple enough.
On a perfectly normal, quiet trading day, a standard institutional-sized trade might have an expected profit value of around $17,500.
Sounds reasonable for a big fund.
Now, on a crowded day, a day when every single algorithm is trying to execute that exact same trade at the same time, the expected value of that exact same trade drops to $640.
Wait, from $17,000 down to 600? That's what, like a 96% drop?
It completely evaporates, just vanishes into thin air. And the reason for that is something called slippage.
Explain slippage for us, because I think people experience this even on Robinhood sometimes.
Oh, absolutely. Slippage is simply the difference between the price you see on your computer screen and the price your order actually gets filled at. So you look at a stock, you see it trading at $100, you hit sell. But because there are 500 other massive funds also hitting sell at that exact same microsecond, and there is absolutely no one stepping up to hit buy, the actual price drops to 99, then 98, then $95 before your specific order finally gets executed.
So you were basically chasing the price all the way down the ladder.
Exactly. You are paying a massive invisible penalty just to squeeze your way through the exit door.
This is what they call the Q theory, right?
Right. The exit door is only so wide. If one person decides to get up and leave a movie theater, it's perfectly fine. They walk right out. But if someone suddenly shouts fire and the entire theater tries to sprint through that exact same door at the same time, people get crushed. In finance, they measure this risk using a metric called days ADV.
Days ADV. What does that stand for?
Average daily volume. It essentially asks a hypothetical question. Based on how much this specific stock trades on an average normal day, how many total days would it take for all these crowded hedge funds to fully sell out of their massive positions?
So it's basically a measure of how big the exit door is relative to the size of the crowd trying to leave.
Exactly. And in October 2025, for some of these highly crowded tech names, the days ADV metric was completely off the charts. Mathematically, it would take them weeks of steady selling to exit those positions without completely cratering the stock price. But because of the margin calls, they didn't have weeks. They tried to cram all that selling into 4 days.
And that creates the liquidity mirage.
Right. The liquidity mirage. Liquidity always looks perfectly fine when the markets are calm. You look at your trading screen, you see plenty of buyers, plenty of sellers, tight spreads. You think to yourself, I can easily get out of this position whenever I want. But that perceived liquidity is nothing but a phantom. It disappears the exact moment you actually need to use it.
Because the buyers you saw on the screen were mostly just other algorithms, and they all simultaneously switched their settings from buy to sell.
Exactly. The entire other side of the trade just simply vanished. Everyone desperately wanted out, and absolutely no one wanted in.
So stepping back and looking at the big picture here, we have this incredibly powerful mathematical strategy, momentum. We know for a fact it works beautifully over the long run.
Yeah.
But we also know it has this terrifying, fatal flaw where it completely blows up during market rebounds. And we know that algorithmic crowding makes those blow-ups exponentially worse.
Yes.
So is the ultimate answer to just stop doing it? I mean, is momentum investing basically dead at this point?
Oh, no. Far from it. As the Robico research report points out, momentum is eternal simply because human behavior is eternal. As long as human beings, and by extension, human programmed algorithms are driven by greed and fear, momentum will always exist. But I will say the era of easy money is probably over forever. You can't just run a simple buy winners, sell losers, bot in your basement and expect to print money anymore.
So how do the pros actually tame the beast? How do you keep those high historical returns but manage to avoid the devastating crash?
There are two main highly effective approaches mentioned in the recent literature. The first is called dynamic momentum, and it was primarily proposed by Daniel and Moskowitz.
Dynamic momentum. How does that actually work in practice?
It basically programs the algorithm to read the room. We know from the historical data that these momentum crashes always happen in specific panic states during high volatility, deep bear markets. We know what the setup looks like. So the algorithm should be smart enough to recognize that dangerous setup.
So when the market starts getting really scary and volatile, the algo just chills out.
Exactly. When market volatility severely spikes, the dynamic strategy automatically scales down its total market exposure. It actively reduces its leverage. It shrinks the size of all its bets.
It's just taking its chips off the table and waiting in the lobby for the storm to pass.
Right. Now, if you do this, you will obviously miss out on some of those initial rapid rebound gains, sure. But the math proves that you successfully avoid the catastrophic 80% wipeout. And the research actually shows that implementing this dynamic scaling effectively doubles the long-term Sharpe ratio, the overall efficiency of the momentum strategy.
Honestly, that seems like a total no-brainer. Why doesn't literally every fund manager do that?
Well, many of the top ones do now, but it requires an immense amount of discipline. It is incredibly hard for a human portfolio manager to just sit on their hands when the market is moving incredibly fast. Managers constantly feel immense pressure from their clients to do something, to be active.
Right. What's the second fix then?
The second major fix is the diversification of signals. You don't just solely rely on simple price momentum, meaning just looking at the price chart. You also incorporate fundamental momentum.
Fundamental, meaning like corporate earnings and balance sheets.
Yes, looking at persistent earnings surprises, tracking Wall Street analyst revisions. You look at the actual underlying business performance, not just the stock ticker.
Hmm.
Or you can use something called residual momentum.
What is residual momentum?
It's a way of looking at a company's specific price behavior after you completely strip away all the broad sector noise.
Oh, okay.
Yeah.
So if the entire technology sector crashes, but this one highly specific software company is doing something completely unique and moving differently, the residual signal might catch that and save you.
Exactly. The whole idea is to have multiple mathematical signals that aren't perfectly correlated with each other. If standard price momentum suddenly crashes, maybe your fundamental momentum signal holds up and acts as a buffer. You are essentially building a much sturdier boat, a multi-hulled boat instead of a canoe.
But there has to be a limit to all this, right? Even with a sturdy boat, you can't just keep adding more and more billions of dollars into these strategies forever.
You've hit on the absolute biggest problem. That is the capacity issue. Momentum strategies, by their very nature, have incredibly high turnover.
Because the winners are always changing.
Exactly. You are constantly forced to buy and sell every single month just to make sure you stay in the current winners. And all of that constant trading costs a massive amount of money in broker commissions and bid-ask spreads.
So if your fund gets too big,
If you get too big, you literally become the market. You can't execute a trade without dramatically moving the price against yourself. So there is a very real mathematical ceiling on how much global capital can actually be managed using this style. You could never have a massive behemoth like Berkshire Hathaway running a high-frequency momentum strategy. It physically wouldn't work.
they're just too fat to fit through the exit door.
Exactly. They'd crush everyone, including themselves.
So as we wrap this up, let's bring it all back down to the listener. Obviously, most people listening to this deep dive aren't running a multi-billion-dollar quantitative hedge fund from their laptop. Though, if you are, hello, and I am very sorry about that AMD trade.
Very sorry.
But for the regular retail investor, or honestly even just someone who's generally interested in how complex systems fail, what do you think is the really big takeaway here?
I think that the biggest takeaway is a fundamental rethinking of the nature of risk itself. We usually tend to think of investment risk as, what if the specific company I own goes bankrupt? Or what if the broader economy enters a recession? Those are what we'd call fundamental risks.
Right. But this whole momentum crash phenomenon exposes a completely different kind of risk.
It perfectly illustrates structure risk or crowding risk. It teaches us that risk isn't just about what specific asset you own. It is equally about who else owns that exact same asset.
So if you are standing in an incredibly crowded trade, even if it's a quote-unquote good trade, like betting on AI in 2025, you are fundamentally completely subject to the erratic behavior of everyone else who is in that trade with you.
Precisely. If everyone else in the room is highly leveraged and they all suddenly get margin called and have to sell at the exact same moment, your perfectly good, fundamentally sound asset is going to completely crash anyway. True risk is not just about the asset itself, it's about the invisible liquidity conditions surrounding that asset. It's about whether you can actually fit through the door when the fire alarm inevitably rings.
And as we saw so clearly with the whole GM and AMD and NVIDIA example, sometimes the safety hedge you put on is actually the most dangerous thing in your entire portfolio.
It really is a massive lesson in humility. The stock market is a hyper-complex adaptive system. Every single time we think we found a perfect, unbreakable, rule-like momentum always works, the market eventually, inevitably evolves a new way to brutally punish the people who follow that rule too blindly.
Because it just crashes upward.
It crashes upwards.
Well, I want to leave you all with a thought that has genuinely been nagging at me ever since we started researching this topic. We spent a lot of time talking about how all these sophisticated algorithms are currently converging. They're all using the exact same mathematical signals, buying the same data sets, deploying the same risk models. If the machines that essentially run our modern financial markets are all hard-coded to panic and exit at the exact same millisecond, are crashes really anomalies anymore? Or are they just a guaranteed built-in feature of our financial future? And when the next inevitable panic rebound happens, will you be betting against the trash rally? Or will you be brave enough to actually try and ride it?
Now that is the multi-trillion-dollar question.
It really is. Thanks for diving deep with us today. We will see you next time.